Welcome to the Art of Money podcast with Art McPherson.
And thanks for checking out the Art of Money podcast. My name is Mark Owens alongside Art McPherson and Luke McCarty. All the information for the McPherson Financial Group, you can find it at theartofmoneyradio.com. Let's get to it because inflation at a 40-year high. The Fed aggressively raising interest rates to try to get it under control. Now, the next commonly asked question is whether a recession is coming. USA Today's Elizabeth Buchwald says research from Deutsche Bank is predicting one could come as early as next year.
While everyone is always scared of hearing the word recession, it doesn't have to be horrible. And the economists are predicting that it's going to be relatively mild because Americans have good paychecks. Paychecks are rising. We have lots of jobs, low unemployment. So those factors all are to say that even if there are job losses, which inevitably there will be in a recession, that people going into it are going to fare better.
Do you agree that a recession is coming as early as next year?
It's always possible. It's very hard to predict a recession by just looking at any one indicator. What she mentioned about employment, right? That's kind of the strong point of our economy right now is employment. But, retail sales is now negative, right? Real personal income is negative. Housing is strong, but for how long, right? There's so many houses that can be built, but I saw recently this week the 30-year mortgage is 5.5%. So if you do the math on that, if you had a $500,000 mortgage a year and a half ago at 2.5%, you paid about $1,000 a month in interest. You'd buy the same thing today, you're paying $2,000 a month in interest. So we're going to see the housing market slow. Mm-hmm. Those are things we look at. So once we get another negative indicator, we are looking more into a recessionary period. So we can't predict that it's coming, but it's looking more and more likely. But it's still the unknown of what the Fed's going to do. Are they going to let the market continue to go down, let the bond market get crushed, or are they going to say, hey, live with inflation for a little bit longer?
Yeah, the one thing that has been tough about this current market environment is there's been nowhere to really run. Bonds are down almost as much as stocks during this period. So it's been a very tough place, tough market, because the Fed has had to try to address inflation at the worst possible time. So they're having to raise rates when the market is already softening, and then it's making a double whammy on the market and the interest rate markets at the same time. So it's been a tough period. And that itself can make it where things slow down a little bit and things catch. So the good news is if the Fed, with raising rates, maybe they don't have to raise as much as they thought they're going to have to because things are slowing down faster than they expected. So you never know. You could see this developing into a good scenario a couple months down the road. But right now, it's kind of a bad scenario where there's nowhere to run except for cash, and we've done a lot of changes in our models this whole year, but because everything is getting hit at the same time, everything keeps getting affected. So it's just been one of those years where the safest place to go is where interest rates are the lowest. So it's just one of those years.
Luke, we were talking a little bit last week about some of the changes that you've made to the models in the McPherson Financial Group. Tell us again where we can find more information about that.
You can find that on our YouTube page. If you just go to YouTube and go to McPherson Financial Group, you'll find some videos, you'll find some posts, you'll kind of find out what we're doing, but our current clients know exactly what we've done and what we did last week, the changes that we've made, right, out of growth into value, moving some more assets to cash. So our current clients know exactly what we've done, but if you have questions on how your portfolio stands up, just give us a call and we'll let you know what we did in the past several months to help stop the bleeding.
And that number is 321-425-8550. That's how you reach out to the team of the McPherson Financial Group, where Luke McCarty, Art McPherson, want to personally sit down with you and take a look at your portfolio and offer that complimentary income plan to see what your portfolio looks like. Is it recession-proof? And Art, let me ask you that. I kind of need like a Cliff Notes, an idiot's guide to a recession. In its most simplistic form, what causes a recession?
Well, the technical definition is 2 negative quarters of GDP. So what that means is the gross domestic product, so slows down in quarter. You get 1 quarter of negative growth and you get another quarter of negative growth. That is technically a recession. Now, it may not feel like a recession because it's just a technical indicator. So you still may see the economy doing well, unemployment doing well. It doesn't really feel like a recession, but it technically is on the books. And a lot of times when we go through a period like that, it's a buying signal to the markets and things along those lines. So, but that is kind of technically what we go through now. So a recession that we feel is kind of what we went through in 08 and 09 when we had the whole subprime mortgage meltdown. So it took about 10 years for the housing market to recover from that. So you had a house that was worth $1 million, and by the time 09 was done and the market had bottomed in April of 2009, we basically had houses that were $1 million worth $500,000, and it took really till about 10 years later for those to be worth $1 million again. So that was a really big, nasty scenario, but those kind of things will happen, and that's where you feel a recession. So you may have a recession on paper that you don't feel, but it's still technically a recession. But those type of recessions you feel in the economy itself. So I don't think anybody's predicting that type of recession yet. They're looking more of a technical recession. However, it could happen.
And with all this talk of recession and the market swings, some people keep saying just stay the course. But if you're nearing retirement and that's not an option, there was an article in Kiplinger that suggested finding safe harbors for your savings, like annuities, pensions, interest from high quality bonds. So when they talk about safe harbors, do you agree with that being an option?
Yes, we definitely agree, because the safe harbor this year is the only thing that's working. However, in that article, it talks about bonds. It talks about things that historically were safe harbors that are not. So this year, the only thing that hasn't lost money is an annuity, maybe, oil and energy. Even gold is kind of down for the year. So there's not a lot of places to hide this year other than cash, which is losing purchasing power because of inflation, or an annuity, which may have some guarantees in it, may have an income play. Maybe flat for the year, but being flat right now feels really good when bonds are down 10 and the NASDAQ's down over 20. So you definitely need these in the portfolio, because you never know when a year like this is going to happen. Coming out of last year, it felt like we were going to have another good year, right? It looks like we're heading into the midterms. We're going to be a little bit rocky, but there wasn't anything really on the radar until inflation. So there's always a lot of unknowns. So you always need those in your portfolio for times like these.
Art, let me ask you a question, because, Luke was talking about bonds and stocks. Do you believe that the 60-40 is dead? 60% of your portfolio being in stocks, 40% in bonds. Is that still valuable?
It's still valuable, because what you're trying to do is have safe money, just like Luke was talking about, and growth money. And what'll happen is you can't have everything in growth, because right now that is the part of the portfolio that is down 18 or 20%. So if you have 60% of your money in growth right now, you're feeling it the worst. Now, if you're 50 years old or 55 years old, it doesn't matter, because you're still contributing into your 401k every 2 weeks. What matters is if you've already retired and you're trying to live off of that income stream. So you have to have money blended so that you can have a more consistent return, especially when we go through periods like this. And that's exactly why people hate the market and people hate investing, because you go through these volatile periods. Now, it could be at the end of the year, we're up 5, 6, 7, 8%. And all this is just a shot in the pan for a short period of time, but you just don't know. And then when the market is down, just like it is currently, all the information you get on the TV is negative. It's just reinforcing the negative over and over and over. So everything you see on the news broadcasts, everything you see on the market broadcasts are just negative, because it's a snapshot of time, and it's just giving you a snapshot of today's value. Doesn't mean that's where we're going to be in the next year. Doesn't mean that's where we're going to be in 2 years, but it's today's snapshot. So it kind of whipsaws people's emotions.
Every week, our goal is to inform and educate on building a successful retirement plan, but we love to hear from our listeners. We hit the streets to find out from our audience, do you have a specific age in mind for when it comes to retirement, or do you have a monetary number?
Absolutely. 67.
I know I should have more.
Not really. I would say the money I've saved and what I'm doing at the time. Do I enjoy it?
62.
So Art McPherson, Luke McCarty, when you talk to your clients, do you find that more people, they have an age or a number, and what do you recommend?
I think sometimes people will have the age based on Social Security benefits. So a lot of times you'll hear someone say 65, and that's kind of based on close to their full retirement age for Social Security, but it's also the year that their health insurance is covered with Medicare. So all those kind of things go into, I think, a person's perception of when they should retire. We hear a lot of those conversations. One of the things that we can do in our eMoney financial system is we can put in there, if they were to retire retire at 62, or if they're to retire at 64, or retire at 65, 67, it'll calculate kind of what is the best time for them in their unique individual situation to turn on their Social Security. For the spouse, should they turn it on first or should they wait? Do we have spousal benefits that are being paid? And if that is the case, is it better for that person that is going to have a spousal benefit to take it early on their own benefit and then get a spousal benefit later? Or is it better for both of them to wait? Or is it better for both of them to start early? And our system will just kind of show the numbers, and it'll show the pull rate on their 401k assets and all their dollars, any kind of pension plans, anything that they might have, and what that does. And then when we go through periods like right now where the market is not growing, it's actually going down, how does that affect retirement? How does that affect them through the retirement planning? So we kind of go through those stages with people because everybody's worried about that. Will my money last throughout my retirement time? And they want to make sure it does. So we can go into our software systems and show them exactly what will happen.
Yeah, it was unfortunate that everybody who responded to that question, a lot of them were, I don't know, or kind of an age in their 60s. When I sit down with a client here at McPherson Financial Group, we back into that number, which then backs us into that age. So, for example, let's say your number you need to retire to create the amount of income you need is $1 million. Mm-hmm. Well, how close are you to $1 million now? How many years do we think it's going to take to get you there? And then we run different scenarios. What if we have a really good market? What if we have a bad market? What if you have to work longer? What if you have to delay Social Security? What if, you want to buy a second home and do this? So there's a lot of different factors we can put into our system that Art was talking about. It's called eMoney. So if you become a client or want us to run a report for you, you will have that printout that tells you here's what we project, here's what we think. But every day, every month, every year, that number changes because the markets change, your life changes, your income changes. And so it's a living, breathing financial plan.
321-425-8550. That's how you reach out to the team in the McPherson Financial Group, and they can sit down and put a plan together for you at no cost or obligation this weekend. I'm glad you said that. I want you to hear this clip from CNBC's Sharon Epperson. There is a study from the Employee Benefit Research Institute that says 75% of adults believe that they're going to have enough money and be comfortable in retirement. But she says a lot of that is just guessing.
There are a number of people that haven't even done the calculations yet on how much it's going to cost them to retire and what they're going to need to live comfortably all of those years. 42%, that's only the number that have done that type of calculation. And only 29%, that's less than 1 in 3 people, have actually calculated how much money they're going to need for probably their biggest expense, and that is healthcare expenses.
So we talk about the calculations, Art McPherson, and how much does that help people's confidence?
A ton, because a lot of people don't know what they need. While working, your budget works, but you don't necessarily know how much am I going to need in retirement. And then if you're making $150,000 right now, you're not living on that $150,000, because what'll happen is you have your federal taxes get taken out of your check. You have your 401k contributions that get taken out of your check. You get all of those benefits, like maybe life insurance, health insurance, all the long-term care, short-term care, disability type things. Those all come out first. So typically the average person walking into our office has about 60% of their income they actually see. So we build a financial plan based on that take-home money, not their gross money. And then one thing that sometimes will happen is people expect that their taxes will drop in retirement. Not always, because if you have the same take-home in retirement as you had while you were working, there's a high probability you'll kind of be similar or close to the same tax bracket. So making sure people really understand how much taxes they're going to have to pay, how much income they're going to be bringing in the door, and making sure that's enough for them to be able to do their travel, do their trips, do all the things they want to do, and have that last for 20, 25, 30, sometimes 35 years.
I'm so glad you brought up how taxes are something that hit us in the face in retirement. Did you see the story coming out of Arizona? The Powerball hit for $471 million. Now, with the cash option, that's going to come down to about $283 million, still pretty good. IRS is going to take their money, so they're going to take about $68 million immediately, and then another $36 million at tax time. That's life-changing money. But you don't have to be a lottery winner to realize how important having a tax strategy is.
Yeah, tax is a big deal. So one of the things that we just got done is we got done with tax preparation season, right? So getting your taxes done, paying your taxes for last year's income, was done by April 18th of last year. We still have a few returns that we're finishing up, people that had to file extensions. But for the most part, that's done. Now we move into a tax planning mode where what can we do this year to change some of your tax hit that you had from last year? And what kind of financial moves can you do? Are there areas, are there buckets of money you can pull from? Are there resources like Roth IRAs or non-qualified assets that you can take that income you need, but not have it as taxable income? And are there things that we can do long-term over the next 4 or 5 years to reposition money that might now be a taxable income to our client and move it to a tax-free bucket or a tax-deferred bucket, so that becomes tax-free or tax-deferred. So the whole trick to everything is keep your taxes as low as possible. And if you can do that, it really doesn't matter what happens in the future for tax rates, because you're going to be in one of the lowest rates out there.
Yeah, one of the issues, of course, with winning the lottery in that story is a lot of it's going to the tax man. And if you take it up front, you're getting even less of it. So if you think of your 401k and just kind of, dummy it down to some easier math, right? Say your 401k is $2 million. It's all pre-tax. Well, you have to think only 2/3 of that's really yours, because every time you spend it, of course, depending what state you live in and where you file your taxes, a third of that may go to the government. So now your $2 million is really only, mental math here, 1.4 million of actual spendable assets, and then maybe you make a mistake and pay off your mortgage and take $200,000 or $300,000 out. Well, that may cost you even more. So taxes are very, very important. The way you save money currently is how you're going to be able to spend money in the future. And then once you get to retirement, how you position assets, what Art was talking about, and set up different buckets that he talks about in his book, is going to help you navigate your tax brackets in retirement. I think a lot of people forget about paying taxes in retirement. Yes, you've paid them all your life. Yes, you still have to pay them the rest of your life.
Thanks for listening. Want more from Art McPherson of McPherson Financial Group? Find us online at artofmoneyradio.com. We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Securities offered through World Equity Group, Inc., member FINRA and SIPC, a registered investment advisor. Investment advisory services offered through ProStatus Group, LLC. McPherson Financial Group and ProStatus Group, LLC are separate entities and are not owned or controlled by World Equity Group, Inc. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. Art McPherson is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Arthur McPherson. Florida Insurance License number A174725.
Today's show has been a work of art.